Good morning, everyone, and thank you all for joining Base Carbon's third quarter investor update. We're really grateful for everybody taking time out of their business day to join us this morning. With me on the phone, I have our president, Wes Fulford, and our chief financial officer, Kwesi Marshall, who also present alongside of me. Before we jump into it, my lawyers tell me that I need to tell everybody that we have forward-looking statements that myself and my fellow colleagues will be making today. And so please, if you please take a look at the forward-looking statement disclaimer that's on your screen on the webinar. There's lots of really fun legal fine print for everybody to read there. In any event, we'll jump into it. We're going to try to be, pretty succinct. Our business is a simple one, and it's execution based, and that's what we've been doing. But we want to be respectful of people's times this morning, so we'll jump right into it. The third quarter for Base Carbon was a successful quarter. We're as I said, very execution focused during this quarter. And it's really been the theme of this company in the short time that we've been public. We've been public for a really short time, as I said, 18 months. And over that period of time, we've grown and transitioned this business from a business with capital and a lot of upside in the market and a team that was building to a business that has executed on that. We've grown and transitioned this business to a revenue generating business. We generate free cash flow, and we're a carbon producer across three great projects, one of which is producing, one of which is a near producer, and another near producer in early 2025 in our most recent project, our partnership with VNV on our India ARR project. We've done all of that, not only within the quarter, but over the last 18 months without taking dilution for our shareholders. And in fact, we've actually had share accretion through using the normal course issuer bid to use the open market to repurchase our shares when appropriate and in a creative manner for our shareholders. Despite all of that, I've been in junior markets and I've been in resource markets for a very long time personally. And I can, on one hand, think of the scant number of companies in the junior market that have transitioned a business and proven a business model over that short of a period of time, and have done it without dilution, and have done it along the expected base case of the hypothesis and the thesis that was anticipated to be underwritten all along. The unfortunate part is that we've done that in a really, really soft market. I'll talk more about the market later, both the carbon market and the overall capital market environment. But fundamentally, the business itself is incredibly sound. We're incredibly grateful and excited about the prospects that are in our business, not only in the projects themselves, but also in the team. The employees that we have are top notch and dedicate an incredible amount of time, emotional energy, and care to our business. Our broader stakeholders, the developers we partner with, Base Carbon really is a team effort, and the team's firing on all cylinders, and we're really excited about that. Within the quarter specifically, we're focused on a number of key objectives and initiatives. You'll hear further from our CFO, Kwesi, around the financials, and Wes will give a detailed overview of where we stand on each of our three key projects. Within the quarter, we focused on allocation. As I mentioned before, we fully committed the last bit of our initial capital into our reforestation carbon removal project with our high-quality partner, VNV. We're really, really excited about this project. It's our first move into removals. We've always talked to the market about the financial returns within abatement projects are incredible, and we'll continue to focus on those in our business. We think they're wonderful for the world. They're wonderful for the communities. They're wonderful capital allocations. But we understand, we've always talked about the future of carbon markets to be on to removals. And this is our first allocation. It's a high quality project, high quality SDGs, high quality community engagement, high quality developer. And unlike many ARR projects, it produces reasonably soon. So there's a number of characteristics of that project we really, really like. Equal to the quality of the project is the quality of our relationship with our developer, VNV, Value Network Advisors. They have a multi-decade experience in developing carbon projects. They have 19 producing projects that they've developed. They have another 100 projects in various stages of development across multiple methodology types. We've quickly become very, very close with VNV, and we look forward to the opportunity to continue to work with VNV, not only on this project, but hopefully on more projects to come. We've focused on our portfolio and asset management. As a lot of the folks on the phone here know, as portfolio managers, asset managers themselves. Underwriting itself is hard. Execution is hard. But a lot of investing businesses and a lot of people who commit capital fall short when they don't focus on asset management. And so for us, it's at a level it can seem mundane and just repetitive, but it's the regular calls, it's the being on top of the projects, it's having great relationships with our developers, having relationships in the community, being on top of policy. And our team is incredibly focused on that and redoubles their efforts on that on a regular basis. It's a really, really big focus of Base Carbon. It was a big focus within the quarter. And I think you see the results in terms of the quality of not only the portfolio, but the execution of that portfolio. In the quarter as well, we focused on business building. We've continued to develop our underwriting and execution capabilities within the team. We've integrated and brought together our North American-based team with our team based in Barbados. We have a really, really strong commitment to Barbados. When we established this business, we established our operating subsidiary, Base Carbon Capital Partners, within Barbados. We've hired world-class professionals in Barbados, and we'll continue to build that team in Barbados and operate out of Barbados. We think it's an incredible jurisdiction, not just to run our business out of, but it can be an incredible jurisdiction for many of the aspects within our operating business. And we look forward to continuing to explore how we can continue to not just grow Base overall, but grow Base with our footprint within Barbados. And then finally, we continue to lay the groundwork for growth. And I want to be really clear to everybody. Growth does not require dilution. Most businesses in the junior market, especially in Canadian junior markets, we as you know, in prior lives for me, but as investors, have learned the muscle memory that growth is often at the sacrifice of share dilution. That's not required within Base Carbon. We initially set out to prove the business model, but to do it in an accretive way, to do it in a manner that we generated revenue and free cash flow. And as I mentioned before, we've done that. We're also evaluating a number of creative, non-dilutive financing structures for the business where we can continue to grow the portfolio, but not at the cost of share dilution. Everything we do within this business, we think about our equity cost of capital because that is the freight, that is the alternative for us within the business to make good and thoughtful allocation decisions of the scarce capital of the shareholders of this business. So we continue to evaluate, we continue to work on a number of different transactions. To get to the 3 transactions that we have on our books today, we evaluated in a countless number of deals. So for us, it's really, really important to continue that practice, and continue to refine that and hone that as we redeploy our capital thoughtfully into what we see as the opportunities going forward, and again with the backdrop of our capital. With that, I'd like to pass it over to Kwesi Marshall, our CFO, to talk about some of our financial results, and then to Wes Fulford, as I said afterwards, to talk about some of our projects, and then you guys all get to hear from me again at the end. Kwesi, go ahead.
Thanks, Michael. Good morning, all. As Michael said, I'll run you through the highlights of our Q3 financial results, and I'll start with the balance sheet. Key points there. So we have total investments in carbon credit projects of 136.3 million, with 25.6 of that being categorized as current and 110.7 as non-current. As Michael alluded to, we had a new project on board, our India ARR, and the reforestation and revegetation project. And this has total capital commitment of 13.6 million, of which we've deployed an initial 3.6 million. And this goes towards the planting of approximately 6.5 million trees. Now, further details of this and the other projects will be discussed, as Michael said, in Wes's next presentation. So just to give him the highlights and the overviews of the projects today. So the Rwanda project has seen full capital deployment of 8.825 million. The capital deployment for the Vietnam project is now 92% complete at 19.2 million. With contractual milestone-based payments of 200,000 made during Q3 2023. So talking a bit about the Vietnam project, we'll talk about the substantial increase in the valuation which occurred in Q2. And this was through the first issuance and disposition of 1.1 million VCUs. We changed our fair value measurement from a cost to an income basis, and we did this using a discounted cash flow model, a DCF model. And this was in line with project design documents and expected credit generation. So just to have a quick word about the DCF model, there are 3 primary inputs there. the VCUs that were mentioned are the verified carbon units. So the price of those, the VCU volume, and the discount rates. So specific to the Vietnam project, phase 1 prices reflect the contractual arrangement for the 7.4 million credits for which there's an offtake agreement. Phase 2 prices are primarily subject to a forward price curve from Viridios, which is a third-party paid subscription-based source. Now, in terms of volume, the carbon credit production profile is consistent with Verra's VMR 000 methodology. And now talking about the discount rates, the rate of 8% in the rates were used 8% in phase 1 and 15% in phase 2 of the project. And they consider the following: methodology risk, uncertainty of volumes, uncertainty of prices and market conditions, and foreign operations and political risk. And similar to Vietnam, the other projects will also be accounted for on an income basis, utilizing the same DCF model once they move from development to production. Continuing our discussion, we repurchased 4.4 million common shares for cancellation in line with our normal course issuer bid program, or NCIB. This was for the year during the 9 months ended September 30th, 2023. Now, 2,971,000 of those shares were purchased under the previous NCIB period, which ended on June 16th, 2023. Now, 1,505,000 of the shares were then purchased under the current NCIB period. And this program began on June 21, 2023. And under it, it allows us to purchase up to an additional 7,974,471 common shares during the 12 months following renewal. So we'll turn our attention now to the income statement and key points there. So overall, there was net income of 101.3 million for the 9 months ended September 30th, 2023. Now, in connection to the gains on investments in carbon credit projects, 104.7 related to the unrealized gain from the change to the income approach valuation for the Vietnam project. So the use of the DCF model and the income approach, as we spoke about earlier under the balance sheet highlights. Now, 6.4 million represents the realized gain from the sale of the 1.1 million VCUs to the fixed off-taker under phase 1 of that same project. Now, turning our attention to our operational expenses, we incurred a loss for the 3 months of Q3 of 1.7 million. About 0.5 million, 500,000 of the 0.6 million in consulting expenses incurred during that Q3, incurred during that quarter, was part of a one-off and non-recurring expense. This was the final payment and the final expense, and we no longer expect to pay post Q3 2023. So therefore, we expect our consulting expenses to decrease by that 500,000, and consequently our operating expenses, and therefore will normalize. We expect our operating expenses to normalize to about 1.1 million per quarter. So therefore, and finally, the company expects to be profitable and cash flow positive in 2024. And I will now hand over to our President, Wes Fulford. Thank you.
Thanks, Kwesi. So just to touch on some of the sort of project developments and what's currently sitting in the base portfolio, I'll highlight the 3 assets we have in our balance sheet to date. On the project side, during Q2, as Michael and Kwesi highlighted, we entered into an agreement with BNV to facilitate the development of a nature-based carbon removal project, different from the abatement projects that are tied to our household device assets or development projects in Vietnam and Rwanda. This BNV project is focused on the reforestation of degraded rural farmlands in the northern Indian state of Uttar Pradesh. Project will facilitate the planting of 6.5 million trees, as Kwesi mentioned, on degraded rural farmlands in fertile but arid deserted lands in northern India. Project has been designed with a very high level of stakeholder engagement, is expected to yield positive significant impact on local rural farming communities' food security, climate adaptation measures, drought resilience, among several other co-benefits. Approximately 65% of the 6.5 million trees have been planted to date, and the required water and irrigation infrastructure has been installed for these trees. Initial project capital of 7.3 million is anticipated to be drawn through Q1 2024, and 4.4 million of this capital has been deployed as of the date of our Q3 financial reporting. I would broadly categorize project CapEx beyond the initial 7.3 million as maintenance capital to be deployed over the subsequent 10-year period, and we anticipate funding this out of a portion of the project's anticipated cash flows. First issuance from the India project is expected in Q1 2025 and anticipated to continue over a 20-year period, producing an aggregate of approximately 1.6 million credits. Now, a common question we're hearing from shareholders is, why did we underwrite this project? It appears to be longer duration payback, returns look lower than your household device projects, etc. I just wanted to take a minute to address this. In terms of near-term production reforestation projects, which are few and far between, we are anticipating first credit productions in 1.5 to 1.75 years from first capital deployment. And the fact is that these types of ARR projects just do not exist. Typically, you're waiting 6 to 8 years for a tree to mature and begin sequestering meaningful amounts of carbon to justify a verification effort. Here, given the fact that 2 million trees were planted prior to our involvement in the project, this is a much quicker crediting period, which is far more attractive from an ARR project perspective for us and our shareholders as we underwrite the risk associated with these that is commonplace with these projects. In addition, in spite of current market conditions, which Michael will likely speak to after this, considering we have only had this project on the books for 3 months, and considering this project is pre-validation, pre-PDD, nothing on the registry at this point, therefore limited market awareness, we've received a number of unsolicited inbounds looking for nature-based carbon removal, offtake, and even prepayment. We believe these credits are very well positioned with respect to both carbon and both current and evolving market demand for removals with strong co-benefits, as there is very limited nature-based ARR supply out the curve, and given the longer duration capital paybacks typical with these projects, also considering the structural short supply-demand imbalance that continues to unfold, approaching these 2030 net zero commitments as corporates begin to get more serious about positioning their portfolio accordingly. In Vietnam, all 1.2 million fuel-efficient cook stoves and water devices were distributed to participating households in January of 2023, or by January of 2023. Kwesi mentioned that 92% of the capital committed to the project was deployed as of Q3 2023. Remaining CapEx, approximately 1.6 million, in support of ongoing project monitoring and verification expenses, are anticipated to be fully deployed in regular intervals by year-end 2024. In Q2 2023, Kwesi also mentioned a $6.4 million cash monetization of the first 1.1 project VCUs out of Vietnam. These credits were delivered to Citigroup under the contractual fixed price offtake agreement. I'd also like to note that we are commercially prohibited from disclosing the specific offtake price, but the data points are now in our public disclosure to allow shareholders to back into that offtake price. The Vietnam project is currently on a semi-annual crediting schedule, and we expect the issuance of VCUs on a regular cadence. This being said, we cannot control review timelines driven by processing bandwidth at Carbon Credit Registry Verra. Regarding our second anticipated Vietnam issuance, the measurement, reporting, and validation report has been completed by the validation and verification body. Think arm's length carbon auditor. And this report was submitted to Verra for review last month. For reference, the review process was just shy of 3 months for our first carbon credit issuance in Vietnam. In Rwanda, the distribution of all 250,000 fuel-efficient cook stoves was completed late last year. As of Q3 2023, the company completed all project payments, as Kwesi alluded to. Base Carbon expects the first issuance of carbon credits associated with the Rwanda project to occur by end of calendar year 2023 or early in the first quarter of 2024. And again, caution that we remain subject to Verra's internal review timelines, which we cannot control. The joint project registration and verification report has been completed and submitted to Verra by the VBB. We have been assigned a file reviewer by Verra, and we have been through one round of comments with their staff. This is all positive in terms of timelines. This concludes the portfolio update, and I'd like to turn it back over to Michael for closing commentary.
Thanks, Wes. So look, as everybody can see, there's a lot of nuance in this business, but there's nuance in every single business. Resource businesses, industrial, but there's nuance in everything. And I think that, as I said at the get-go, execution is what we've been focused on, and execution is what we've been successful with. And I think the proof is in the pudding in terms of the offtake that we have in place, the timelines that we've hit on our projects, the underwriting that we've done, and we'll continue to hit those offtakes, or not offtakes, wrong word, sorry. We'll continue to hit those timelines, and we'll continue to evaluate, offtake as and when possible. As stated at the beginning, we've developed this durable, repeatable revenue and free cash flow generating carbon business in a really, really short amount of time. And we've done it in soft markets. Junior markets, I don't have to tell anybody on this call, junior markets are soft. Carbon markets are also soft. On the carbon side, we keep getting asked the question as a business, what's the carbon price? There is no carbon price. They say, well, what's the carbon price for household devices? There is no direct price. Carbon has not commoditized yet. There's a range of prices. There's a range of quality. There's a range of durations. But fundamentally, carbon has not commoditized yet. We believe it'll commoditize, but it just hasn't happened yet. So as a result, quality is absolutely, absolutely critical to what you're doing. And our portfolio on the front end, we actively underwrote and curated for quality. As I said, we evaluated an incredible number of deals before we settled on the transactions that we've looked at. And there were some deals that we did very detailed due diligence and got pretty close, but something failed in due diligence. That's why you do the work. That's a good thing for us. When we think about quality in this portfolio, there's lots of ways you can think about quality, but each of our projects has great quality. Some example, and people say, well, what does that mean? High SDG, social and development goals. Across our portfolio, we check these boxes multiple times, but it's not just a box check, it's really bona fide. Things like climate action, that's clearly and of course, given that we're in a carbon business, but reducing inequalities, economic growth, decent work conditions for human beings, no poverty. Those are really good things for the quality of our deals and making them a very valuable economic widget, but it's also just good things for the world. And that duality is really, as an individual, that's really important to me. And I think it should be really important to all of us as a planet. But it's a wonderful thing because economically, it's really good for us as well as stewards of the stakeholders' capital in this business. Community engagement, another really key component of quality. We in Vietnam, women's unions are who helps us distribute the stoves and helps implement the stoves utilization with the families in Vietnam. That's a really, really good thing. And experienced operators, that drives credit quality because the off-takers want to know that there's as close as you can get to certainty of execution that they're going to get their credits that they buy. That's why we work with experienced operators. I talked before about VNV's decades of experience. Both Del Agua and SIPCO, in Rwanda and Vietnam respectively, have done this before. They're, as we've said to people repeatedly, they're quote unquote brownfield operators. That's really important, and not just for us as underwriting, as a capital allocator, but also really important for the quality of the credits and for the people buying these structural shorts in carbon. that are buying those credits. Beyond quality is obviously for us risk reward, and we put a lot of time and care into that. As we've said, we spend a lot of time and care on offtake, which we have in place in Vietnam. We do not have offtake, and we've told the market repeatedly in Rwanda. There's very specific market-based reasons we haven't put offtake in place there yet. We hope to have something to update to the market over a period of time on that. We're actively working with our partners on that. We think a lot about upside. These are carbon in the VCM is an equity-like risk for equity-like return business. And we know that. So we need to know that we have upside or a potentiality of upside, but not, trading off that base case for it. And then the long-term marketability of the credits, having that connection to the demand equation, which we spend a lot of time talking to potential buyers, intermediaries. That's our job, is to have a sense of where this market's going. The market is still forming. There's no doubt about it. Anything that goes from really small to really big, and that's the continued growth assumptions, despite the market feeling soft, we still believe that we're, reasonably small right now in the VCM, and it's going to go to really big. We can throw a lot of numbers around that. We can take it offline with various investors if they want to talk about that. But that is the thesis. The thesis is still intact. As I said at the get-go, we're 18 months into this. This is a thesis that moves to 2030 as the first jumping off point of real commitment on the VCM into corporations' net zero goals in furtherance of 2050 on Paris. So it's a gradual ramp up, and then a really, really quick ramp up as people prepare for that in the middle part of this decade. And so we see the thesis still fully intact. So, when you think about the combination of quality and the combination of a focus on risk reward, the result is that for us and the capital allocations within this business, within our operating business for our shareholders, is positively skewed asymmetric upside for Base and its shareholders. And so in, not fancy words, really simply, we spend a lot of time thinking about how we mitigate the downside case as much as we can. That's underwriting. We spend a lot of time driving as much knowability into the base case. There's always going to be things that are unknowable unknowns, but we spend an incredible amount of time, shining the flashlight all around to make sure we can see as much as we can, and we underwrite for it. And then we make sure we keep the upside exposure, because this is equity-like risk for equity-like return. The final thing is, we're a corporation. You guys are investors, so we're not here to provide, public market guidance, but we have spent careers as people involved in capital markets, as I said in prior lives, and it'd be remiss to not talk about it. The junior markets are really, really soft right now. As I said, everybody here knows it. We're all feeling it in portfolios and PAs and businesses. TSXV, since the time we went public, is down, nearly 40%, if not probably over 40% by the time I'm saying these words on this call. When we look at the junior market, though, we sort of feel like we're a little bit of a little different than most companies in the junior market, in that we generate revenue, we generate free cash flow. We're not dependent on share capital to run our business and keep our business going. Our business is not an option. Even though we have optionality in our business is a durable going concern business. And I think that unfortunately in bad markets, the everything gets painted, all betas go to one, if you will. Everything gets painted with the same brush. Also in bad markets, liquidity goes down. Liquidity is down across the marketplace. And we're no different at Base Carbon, and there's a premium on liquidity right now. One of the good things about the share capital of Base that drives a potential amount of illiquidity is how tight our float is. We've publicly disclosed, and people can look at our financials, and I believe it's in our investor deck as well. Avex Technologies owns 16% of our company. Directors, founders, management own 12%. That's 28%. Round numbers, 30%. When we spend a lot of time talking to our shareholder base, as I think most companies should, and we believe that there's another 5, 6 sticky, long-term, well-capitalized, well-duration of capitaled holders that own another 25 to 30%. That may even be a conservative estimate. So when you think about the share capital at Base, it's a really, really tightly held stock. And the enterprise is being priced on really, really small volumes in the public market that we don't think is actually adequate price discovery across the business of what people think the business is worth. It's just what people think it's worth today in the marketplace. For us, we've always told people we are long-term greedy on behalf of our stakeholders. We're long-term greedy on behalf of our shareholders. And as a derivative, we are long-term greedy on behalf of the environment because of the business we're in and because and the communities that we're engaged in. But the key words are long-term in there. And we're building a business. We're not we're not running a stock, and we care incredibly about value creation and having that recognized in the stock. But I think that what's really, really important is that this isn't about value creation and then get it recognized. The value's been created and will continue to be created. It's really about getting that value recognized in the stock and having a bit of a better market to get there. So look, in summary, one of our directors made a very apropos comment on a call the other day that the winners of the next cycle in cyclical markets, things like resources, the winners of the next upcycle are always forged in that winter of a soft market. And I think it's absolutely true, and it's consistent with my experience throughout a career investing in businesses like this. You never know when you're when you're in a bad market because it feels bad. You never know you're out of it until you sort of say, oh wow, we're out of a bad market. But everything's cyclical. We've all lived through business cycles. We've all lived through capital market cycles, and this is no different. And for Base, keeping our heads down, being thoughtful, executing as we have, continuing to focus on free cash flow and revenue generation in our business, and continuing to focus on managing our dilution or non-dilution, as I should say, and thoughtfully and accretively buying back shares when we can, when it's our best capital allocation within the business. When the market turns, junior markets turn, carbon markets, we've talked about the 2030. There's no change that we see to the anticipated demand, and it's not at 2030 itself. It's people preparing for their carbon commitments in 2030. As Wes talked about, we keep getting unsolicited inbounds on various projects within our book. So we're really excited about the upside. We think we've really thoughtfully underwritten our projects, thought a lot about the downside case, not only at the project level, but at the company level. And we really believe that the combination of all of that leads to a really underwritable and durable business for our investors and shareholders. So with that said, I'm sure you guys have had enough of us and you have lots of questions. Why don't I turn it over to our colleague Lindsay to coordinate some questions for everybody. Thank you all for listening, and thank you for taking the time with us this morning.
Thanks, Michael. We'll now begin the Q&A portion of the call, starting with the questions pre-submitted to Investor Relations. And if time permits, we'll take questions from the Q&A chat.
Thanks, Lindsay. I can help. It's Wes here again. Just coordinate some of the queries prior to the call and during the call, and doing the best I can to reconcile what we have already responded to during the formal presentation part of this call. The one noteworthy question that came in prior to the call was, what about DAC? What are our initiatives in direct air capture, more technological-based carbon removal? Michael, I'll pass that one over to you. If you want to provide some comments.
Yeah. We're big fans of direct air capture, but we think it's still very early stage technology. So I'll give people an anecdote. Sorry about that. I just want to make sure I wasn't on mute as I was speaking to everybody. So we became aware of a large, well-capitalized, well-run, in our opinion, direct air capture, which I'll refer to as DAC here on in, business, that their cost of production, they're all in cost of production, at a reasonably close to commercial scale. So this isn't lab scale, this isn't pilot scale, but reasonably close to commercial scale was $500 to $700 a ton. To do that, you need incredibly and it's really, really capital intensive. So if you think about what you need to be in a DAC business, you need really, really low cost of capital, which everybody sees our share price. We don't have a low cost of capital. It's an opportunity for us. We're well capitalized, but we don't have a low cost of capital, i.e. our shares are cheap. Number two, you need an incredible amount of capital. These are multi-$100 million projects, if not into the billions sometimes. Like we're not to that level of capitalization. And then number three, there's still a lot of unknowability on the technological side. So there will be winners on the DAC side where we spend time thinking about it. At some point in time in the life cycle of Base Carbon, I think that there's a high probability that there will be a DAC business or a DAC capital allocation or multiples within our business, but it's not something for the near term. It feels more to us like it's on the side of gambling as opposed to, thoughtfully allocating the shareholders' capital given where Base is at. But it's something we really pay attention to over time. At those prices of offtake, you really, you got to land the plane, or at production, you got to land the plane almost perfectly on offtake. You have to land it on capital, and you have to land it on operations without any hiccups. And that's without somebody coming out of the woodwork and having something that's slightly better on the cost curve than you, slightly better on quality. So, we think about it. We think it's really cool. We think there's lots of upside in it for the industry, but it's not something for us in the short term.
Looking at sort of moving over to the live chat, we've got a number of questions from our research analyst over at Raymond James, David Casada. I think you've answered the first two in your sort of closing narrative. The third question here, as you start to accumulate cash, could you discuss how you'll think about allocating that capital? I could sort of lead with a little bit of an explanation about what to expect in 2024 from an accounting and cash flow perspective. As we did the best, a fairly good job trying to explain a complicated international financial reporting standard around, carbon credits being treated as financial instruments, unrealized gains, realized gains being crystallized as the credits are produced, and having those monetizations flow through our income statement, balance sheet, cash flow statement, and how to sort of read through some of those nuances. I just want to highlight the way the assets valuation is treated in the development stage of a carbon project is it's accounted for, accrued at the cost of investment. So we put during Q3 2023 $3.6 million in first initial capital commitments into the VNV ARR, India ARR project, which is reflective of the current carrying value of that asset on our balance sheet as of the end of Q3. That spend is capitalized, and as we move the projects into production, what you'll see in 2024 is certainly in phase one of the near-term or producing assets, Vietnam and Rwanda. You'll see credit monetizations with no corresponding cash outflow tied to those monetizations because the capital's been spent, it's behind us. You'll see an accounting charge as we depreciate that asset off our balance sheet and crystallize the unrealized gain currently sitting there. But there will be no corresponding cash outflow under the initial phases of both these projects, i.e. you'll see the cash build, you'll see our cash balance grow quarter over quarter as the projects produce on the anticipated semi-annual cadence. But with that preamble, maybe Michael, do you want to talk about recycling cash flows and how we evaluate additional investments, or how we approach additional investments going forward?
Yeah. So there's a couple. So thank you for that, Wes. There's a couple of things I'd say. Number one, and I said this in my commentary prior, everything in a business needs to be viewed at through the lens of the equity cost of capital of the business. So that's sort of step number one. Number two, when we think about capital allocation, I saw another question in the chat around, hey, we've allocated into VNV India ARR, which is a removals project, is the portfolio being transitioned that way. For us, it's about we're an operating business. I want to be crystal clear about that. But there is underwriting in every kind of operating business, even in industries outside of us. And there's a specialty finance aspect of that each deal is evaluated on its own, because as I said, there's no one standard. There's a lot of nuance. So when we think about allocating capital, it really is what is the knowability of the transaction? As I said in my comments at the end there, how knowable is the base case and how much can we truly underwrite and hang our hat on it? how boxable is the downside? Like, how do we think about value at risk in the downside, and how do we make sure that we're not, unduly risking our shareholders' capital? And how do we make sure we have some exposure to the upside? Those are the lenses. That sounds pretty simple and trite when you think about it, but those are the guiding principles and the lens of how we commit capital. In terms of where we're going to commit capital, as I've said before, our equity cost of capital is a place that we anticipate in continuing to, at these levels, continuing to be buyers. We've been buyers, and we'll continue to be thoughtfully. But you don't grow a business by buying your shares. But there's a level by which the accretion is just so astonishingly high that we're happy to be buyers that way. Number two, in terms of continuing within carbon allocations, or within the vein of carbon allocations, which would be the vast majority of capital reallocation. As we've talked about the removal side, we do view the market transitioning there. And I would put it in sort of power industry context at a level. We view the base load of where we'll allocate capital going forward to be on the removal side. However, we continue to think that the abatement side, the avoidance side, continues to have really attractive capital allocations, but it's not sized, and it doesn't have the legs in terms of duration as we view the removal side. So we're going to be really thoughtful about it. It really needs to have high quality SDGs. It needs to be with the right developers. It has to have that right mix, as our two current projects do. But we're happy to do that. But that's going to be more peaking capacity into the mix of the operating portfolio as time goes on. And the other thing I'd say is we continue to evaluate other methodologies. We've talked about them prior on other calls. And, that is, we think about those methodologies and those businesses being a real key mix for our business, but in 25, 26, 27, but we may allocate small dollars as we scope out those, but keeping a focus. You're not going to see $500,000 capital commitments in our business because we're scoping things. It's going to be this is a rifle shot, not a shotgun business, and it'll continue to be such in terms of how we allocate capital.
Moving on to the next question, I think we've answered this in a variety of ways, but how do you see the pace of new projects picking up in terms of timeline and what you want to see change in the market environment? I can start there. But I guess through crisis presents opportunity. We are far from a crisis, just to be crystal clear to our shareholders and prospective shareholders. But the market is soft while we await further sort of policy and regulatory clarity. We're not the same market we were in 2021. That being said, if you are positioned in the right projects with good deal protections through structuring, we see this being an incredible time to continue deploying capital and scaling, diversifying the portfolio. We're seeing deal flow now that certainly wasn't available to us 2 years ago, and some of that is just a function of the market, the state of the market, and a smaller universe of potential financiers being available to project developers, and two, also just I believe our market presence, being a publicly traded business in this sector, having regular continuous disclosure, PRs, being active on our social channels, participating in conferences all over the world. We're building a brand and a reputation, and seeing deal flow now and opportunities to deploy capital on much stronger economics than were available to us 24 months ago. I don't know if you want to add to that, Michael.
No, I think we're seeing, as Wes said, we're seeing equal to better deal flow in terms of volume. We are getting, the market is softer, therefore we're able to drive better terms. I think that we've always been focused on quality, and we think that there'll be a continued shakeout of things that are not quality within the market. We gave a sense to people of what we think is quality, and good market, bad market, everything in between. our underwriting practices are the same, and we've been very, very open with the street and with counterparties we negotiate of what we care about on behalf of our stakeholders, and we're unabashedly, and singularly focused on those aspects of quality as we underwrite. I think it's the doing of it is nuanced, but the actual principle of it is really simple.
What tools are you using to draw in alternative capital sources to avoid share dilution? I think you hit this already in some of your previous commentary, Michael. You just want to be crystal clear. 2024, management believes it anticipates is going to be a year of positive earnings and cash flow positivity. When investors read our Q3 financial disclosure and look at the capital deployments into BNV, what I'd also like to clarify is that the pace and quantum of the Q1 capital deployments, Q1 2024, is scaled or sequenced to the existing portfolio and some of the liquidity within that portfolio, or anticipated liquidity in that portfolio, that the portfolio that predated VNV. Just trying to be careful with my words there, but we do not anticipate being in a position where we need to access the public markets. We continue to be active with the NCIB. We continue to do so given our perception of value, what we're scaling, what's to come in the business, and this being an attractive price to acquire shares. And 2024 is certainly going to be a very transitional year for the business. Anything to add?
No, I have nothing to add there. The reason, really simply, the reason that I keep talking about the lack of dilution is A, we don't need it. We generate free cash flow or need to issue shares. And secondly, I talked about this before. It's the muscle memory of having spent a career investing in junior markets, especially resource companies. They always come back and they ask, oh, there's a deal. And what I want to message is that this business is just a fundamentally different business than most of the resource companies that we're used to within the NEO, within the TSXV, within junior markets within Canada. So I've focused on that repeatedly because it's just a different business, and I think people need to understand that, because we're all painted at a level with the muscle memory of our experiences, especially within capital markets.
So I think that concludes the Q&A. Maybe I'll just ask Lindsay to confirm that nothing further has come in through our investor relations inbox, and turn it over to you for closing comments, Lindsay.
Thanks, Wes. Nothing new has come into the investor relations inbox since we started the call. So I guess that wraps up our Q&A. And I want to thank Wes, Michael, and Kwesi for their updates today. And that will end our call.
Thank you, Lindsay. Thank you, everybody that joined. Again, as I said at the onset, time is scarce. We're really grateful for everybody's focus, everybody's support. We think we have a really cool business here, a really durable business. There's been a lot of hard work for the employees. Thank you to all the employees and all the stakeholders that help make this happen. And we'll continue to provide these regular updates to people. And we look forward to talking to each of you. And there's any more specific questions, we spend a lot of time with investors, so just reach out to the investor line, and we're happy to spend time with people as needed.